Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing CACI stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. CACI is a specialized IT company. It provides services to many branches of the US federal government, including defense, homeland security, intelligence, and healthcare. It also has commercial and international clients. The company consists of 22,000 engineers, inventors, scientists, analysts, developers, and programmers. An example of something that it provides is the maintenance and customization of enterprise resource planning systems. These ERPs include financial, human capital, and supply chain management. It also uses Amazon Web Services and Microsoft Gold Cloud for cloud-based systems such as SaaS, cybersecurity, and network security. It designs, implements, protects, and manages secure enterprise IT solutions for 50 federal agencies to optimize efficiency and performance. Its international operations are conducted through its subsidiaries in Europe. This division provides a mix of IT services, proprietary data, and software products serving commercial customers in Europe mostly, but also in other countries. The original name of this company was California Analysis Center Inc. Then it was changed to Consolidated Analysis Center Inc. And now it is just CACI. The company's competitors are Accenture, Capgemini, Infosys, SAIC, and Booz Allen. The company is headquartered in Reston, Virginia, and was founded in 1962. It trades on the New York Stock Exchange, Mexican Bolsa, and Deutsche Börse. Let's get started with the model. This is a mid-cap company, 6.7 billion market cap. They're trading at $285 a share, and they have 24 million shares outstanding. Let's look at the financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video, and free cash flow is cash flow from operations minus capital expenditures. They had 300 million in 2018. Then after that, it was around $500 million a year. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that's around 300 million in 2018, 19, and 20, but close to $500 million in 2021. Revenue is the sales for the company. That increases at a pretty good rate each year from 4.5 billion to 6 billion. This is the company's income statement. The top line is the revenue, the sales. Here's a breakdown of their 2021 revenue into different categories. More than half their revenue is cost plus fee, and it's all domestic. None of it is international. This type of agreement includes fixed cost. In addition to that, they may get reimbursements for certain expenses, and also they may get fees for certain milestones. For fixed price contracts, that's mostly domestic, but there is some international in that as well. As the name indicates, it's a fixed, agreed upon price for the products or services this company provides. But when you agree to a fixed upfront cost, there is a chance you go over and you end up losing money on that project. Another way a customer can pay is for time and materials. This is usually a payment based on how many hours this company provides their service for. And they generated money in the US and internationally for this option. A bulk of their revenue is from Department of Defense, and their biggest customer is the United States Army. Also, they do a good amount of business with the US Navy as well. They did 1.6 billion of revenue from civilian agencies. This includes all non-Department of Defense agencies, such as Departments of Justice, Agriculture, Health and Human Services, and also state agencies as well. They also do 97 million of commercial business in the US, 175 million internationally. So you can see we don't work with international governments, which makes sense. They don't want to give us their secrets. So you can see almost all our revenue is done with the government. So it seems like they have a lot of opportunity to do business with non-government services. But once you get a government contract, that's gold. It's guaranteed, predictable future revenue. And the government has really deep pockets, so I'm sure the margins are much higher than working with a commercial agency. And this company is usually the prime contractor on projects. Once in a while, they are the subcontractor where another business is leading the way. But most of the time, as you can see, they're in charge. Their revenue is split, half in expertise, half in technology. Expertise is providing human talent for various things like strategy, consulting, or management. And technology is providing the physical software or systems to help the government agencies. When you're an investor in a company, you're technically an owner of that company, but you make no decisions on the day-to-day operations. That's all left to the management of the company. The only thing you can do as an investor is look at the numbers and try to understand them and gauge whether you want to invest in that company or not. Below revenue is the cost of revenue. These are the expenses directly related to generating the revenue. Revenue minus cost of revenue gives you your gross profit, and that seems to be going up every year from $340 million to $540 million. And they spent $40 million of interest on their debt in 2021, which was a lot lower in 2020. And the bottom line of the income statement is their net income, which looks really good each year. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. So they generate a good amount of cash flow each year. They invest a little in CapEx, $40 to $70 million a year. CapEx is investments in property, plant, and equipment. Operating cash flow minus CapEx gives you your free cash flow. And free cash flow is the cash that's remaining to pay a dividend. They don't pay a dividend, but they do buy back stock. They bought back $500 million in 2021. When a company buys back stock, it decreases the shares outstanding, making your shares more valuable. But another way to add value to the investor is to pay down debt. And they are paying down debt in some years, but not in all the years. So you may be wondering, what are they doing with all the cash flow? You can see they have a lot in investing cash flow. CapEx is part of investing cash flow. In 2019, it was $48 million of CapEx, but they had over $1.1 billion in investing cash flow. So what else did they invest in? This is their investing cash flow section from 2021, 2020, and 2019. So you can see they spend a lot of money in acquiring other businesses. They spent over $1 billion in 2019, $100 million in 2020, and $356 million in 2021. That's another way to help investors, is to acquire other companies, grow your brand, grow your revenue, and hopefully your stock price goes up. As long as the investment in these companies results in greater cash flow in the future. For example, if they spent $1 billion by buying this company in 2019, but this company only provided them an extra $10 million of free cash flow each year, that's only a 1% return on investment. So they would have been better off not investing in this company. But what if this company resulted in $333 million of extra free cash flow a year? That's a 33% return on investment. Then this acquisition provided great value to the investors. Sometimes the company doesn't let us know how each individual acquisition is performing. The company management has all that information, but you could just look at how the company's performing before and after the acquisition. This is the equity section of their balance sheet. They have $2.7 billion of equity. They raised $500 million from selling their business, and they profited $3.2 billion from running their business. Retained earnings is a sum of all your prior net incomes. So they've done really well. They took that $500 million investment and gave you a return of $3.2 billion. Plus, they bought back $1 billion of treasury stock. When a company buys back stock, it takes it off the market and puts it onto the balance sheet as treasury stock. This is a contra equity account, so it decreases your equity value. Let's look at the capital structure. $2.7 billion of equity, $2.2 billion of debt. They're 55% equity, 45% debt. And their WACC is 7.5%. That's the highest WACC according to Finbox. And that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year for, that's $12 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $11 billion. We divide that by 24 million shares. And we get a calculated stock price of $463. They're trading at $285, so they're trading at a 39% discount. It's a strong buy according to the model. The average analyst projects their revenue to grow 4.3%. I grew their revenue 4.3% for the next 4 years. That's how I got their future revenue estimates. To get their future free cash flows, I need to see what percent of their revenue they convert to free cash flow. So I summed up these 4 free cash flow numbers. I divided by these 4 revenue numbers. And that comes out to 8%. So I multiplied their future revenue estimates by 8%. That's how I got their future free cash flows. This does seem to be a reasonable estimate, and the stock is trading at a deep discount according to my model. Simply Wall Street values the company at $4.94 a share. They're saying it's 42% undervalued. 4 analysts priced this stock and the average price target was $2.99. 10 analysts priced this stock and the average price target was $3.02. The low was $2.83, the high was $3.25. 12 analysts rated the stock, 6 a buy, 3 an outperform, and 3 a hold. The stock has done really well the past 12 months. It's pretty much only gone up. There was a dip at this point, so I'm not surprised. They're putting up great numbers and they're always consistent year to year. That's what you like to see when you invest in a company, consistency. They have a beta of 1, so the stock moves with the market. It's gone up 39% in the past 52 weeks, while the S&P is up 34%. But if you add the dividends from the S&P 500, it's pretty close to this company's 52-week change. The 52-week low was 198, the high is 288, and the stock is trading above its 50-day and 200-day moving average. This is not a popular stock. Only 150,000 shares are traded on average each day. Of the 24 million shares outstanding, 23 million are on float. 92% are held by institutions, so it has a really high institutional ownership, and less than 2% of the shares are shorted. Here's the company's short percentage from its history. So it was really low for a while, and it got up to about 20% at one point. It looks like 2013-14. I wonder why the short percentage was so high. Now it's below 2%, but just a few months ago it was close to 8%. Their employee count is fairly steady. It is growing a little bit each year, so that's a good sign. If you put $10,000 into this company 10 years ago, you'd have $53,000 today. That's an 18% annual return. The stock is trading at its all-time high, but just because a stock is trading at its all-time high doesn't mean it can't go higher. Same thing if a stock is trading at its all-time low, doesn't mean it can't go lower. For the past year, insiders have pretty much been selling. They haven't been buying the stock, which is usually not the best sign. Most of the sales are from Warren Phillips. He's the director at the company. Their biggest shareholder is Vanguard at 9.5%, then BlackRock, Fidelity, Eaton Vance, and Dimensional Fund. Let's look at their financial ratios. They have amazing price multiples. Their PE is under 15. That's stock price over earnings per share. The market median is 22. The average is 32. The lower the better for this ratio. They have a really good price to sales ratio of 1.1 and a good price to book of 2.5. Price to book is stock price over book value per share. The way you calculate book value per share, it's equity on a balance sheet divided by shares outstanding. Equity is assets minus liabilities. And they have $2.7 billion of equity, but they have negative tangible equity, negative $1.4 billion, since they have over $4 billion of intangible assets on their balance sheet. A company gets intangible assets on its balance sheet when they acquire another company for more than it's worth. So this shows you they do a lot of acquisitions, which is not a bad thing because some industries need to do acquisitions to grow. Sometimes it's hard to grow organically. As long as you generate more cash flow than you paid for the acquisition, it's fine. But if you're acquiring companies and you're losing money on those investments, that's obviously a bad thing. They have a good return on invested capital, above 10%. You want to see at least 10% when you're investing in a company because that's generally the market average over time. They can easily cover their interest payments almost 14 times. They have a high ROE at 17%, much higher than a market median of 7%. And they have a good current ratio of 1.5 and a quick ratio of 1.4. So they have $88 million of cash on their balance sheet, $879 million of receivables. So this indicates the government does not pay its bills on time. They do seem to be well capitalized. They generated over $500 million of free cash flow in 2021, and they have $446 million of working capital. Working capital is current assets minus current liabilities. So they have almost $1 billion of funding. The best way to look at ratios to compare them to companies in the same industry. I've done videos of 16 companies in the same industry as CACI. They're better in every single category except market cap. Their PE and price to sales and price to book are much better than average. So this indicates a company is really undervalued if their price multiples are so much better than the average. They have a high current ratio, high ROE, and their debt is lower than the average. And the average company in this industry has a $33 billion market cap because there's some really big companies in this industry that are dragging up the average. Their market cap is $6.7 billion. To summarize, I have them trading at a 39% discount. Investing in the US government is almost risk-free. When you invest in this company, you're investing in the US government. So it's going to be a really stable stock. There's almost no risk of this company going bankrupt unless they do something really foolish. And they have a backlog of government contracts, so they have more work than they can handle. I rank their free cash flow 7 out of 10, their revenue 8 out of 10, and their ratio is 9 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.